CSA curve in interest rate swaps explained. So what is this product really is? It's a collateral, something pledged as a security for repayment of a loan to be forfeited in the event of a default. And these are OTC derivative instruments, which means privately negotiated instruments in trades within the legal framework. And these are governed by ISDA master agreements, and ISDA stands for International Swaps and Derivative Association, and these contracts are governed by ISDA master agreements. And what is CSA stand for? CSA stands for Credit Support Annex. This act as a regulation to the collateral in ISDA agreements in OTC transaction related to derivatives, and the main purpose is be a guidance in post-collateral event and ensure mitigating insolvency risk and potential losses associated with derivative trades. So understanding the CSA curve, let's look at a brief on the origin of this all this. Credit crisis brought out the fundamental flaw in interest rate modeling. The same framework cannot be used to understand more complex derivatives, since the underlying is not as straightforward as an interest rate. The ignoring factors were credit and liquidity. During credit crisis, most swaps shown drastic increase in spreads well over their standard rates, and existing models were not able to comprehend when additional likelihood of the counterparty default risk also questioned the standard model. Current models incorporate standard models adjust to the default and liquidity risk discount models. And before the credit crisis, the spreads between overnight yield curve and yield curve from swap rates were minimal, but these spreads are the one which drastically changed on crisis and creating an incomprehensible credit risk to the both parties to the contract. The overnight calls on the collateral provides a limited risk environment to the ended parties by closing out trades that would not meet the set standards. Prior to the financial crisis, there was little difference between overnight yield curve and the yield curve derived from the swap rates. During the crisis, the spread between two yield curves widened. Although overnight index swaps were introduced fairly recently, some developed markets now have highly liquid OAS trading activity, most notably US, European Union, UK, and Japan and Switzerland, which enabled reliable valuations. Now, before we go further, we have to understand overnight index swaps. So let's do a brief on OIS discounting. Swaps are better understood in the interest environment. Often the operation is either floating leg or fixed leg. The bulk industry is usually guarding against exposure risk in the interest rate changes. As like in any instrument environment, the cross-functional disputes of demand and supply give rise to usual speculation. Whenever a receiver of interest expects it to drop and payer expect it to rise, this would create a classical buy side and sell side of swaps with within two positions two positions for each player, buyer and the writer. Instruments are usually OTC, that means over the counter, but we can hope that higher liquidity may give it an exchange existence pretty soon. In theoretical terms, OIS is a fixed floating interest rate swap that is indexed against an overnight rate. This overnight rate can be viewed as a normal example of underlying, in the sense of see it as an underlying to grasp things. So for the following underlying, we have US OAS, federal effective rate in US, and even here this European Central Bank Euro, it will be currency, and SONIA for the British sterling, and TOIS for the Swiss franc. So what are they used for? There is nothing much to argue on the use of the second degree financial instruments, which is naturally for hedging purpose. But unlike classical instruments, the ability to use them to create a perfect case hedge on the portfolio is relatively remote. But increased exposure would demand diversified risk mitigating instruments that deliver to the occasion. So downside of the same would be lower liquidity, and the same reason creates wide and bid and offer. That means it creates a bigger spread since due to the lower liquidity, which has to be managed in clear-cut terms, which often leads to the poor use of these instruments. End of the day, it may not serve the purpose for the investor or the trader. Calculation is often the averaging of floating leg and fixed leg interest rate accruals, oversimplified, but for the time being, let's understood like that. Calculation is often averaging of floating leg and fixed leg interest accruals. For better grasp, it's good to look at into interest rate swaps, swaps of LIBOR, OIS, hedging, etc. So understanding the fine red line between OIS discounting and CSA discounting, CSA discounting is limited to collectivization of trades when it's applied OIS discounting. The basic assumption is on CSA is it's perfect, and OIS discounting is done on cash flows when CSA is expected to be perfect, and parties to the contract is having identified liquidity posted. Use of CSA curve in interest rate swaps. In plain note, avoid defaults in OTC trades via surprise credit risk and take active part in contract pricing. So these are the primary uses.